In trading, there are many ways to lose money, but pro traders know how not to make them. How to avoid common mistakes and find your ideal strategy. In this video, we will look at why indicator analysis often doesn't work and what typical mistakes beginners make during analysis. We will know how to use support and resistance levels correctly and how to recognize accumulation and distribution phases. Watch this video to the end and let's get started. Early on, I thought the more indicators I have, the better my trades would be. But there is truth. Complex indicators, especially when you layer them on top of each other, often give conflicting signals. They are lagging tools, which means that they are reacting to what's already happened. That's why I would often exit or enter the trade too late, missing the actual momentum of the market. Like most beginners, I started with popular indicators like RSI, MACD, moving averages, thinking they or their combination would be the secret formula. The problem? They are reactive, not predictive. I ended up focusing on these complex patterns instead of understanding where the price actually was moving. Complex strategies rely on fixed formulas that don't adapt when the market changes. Market dynamics shift constantly, and when we rely too much on rigid setups, we end up missing real trading opportunities. This is why over time complex strategies don't hold up. By clearing away the garbage from the charts and focusing on basics, pure price action, support and resistance, volume, I began to see markets' real direction. Simplicity allows us to see markets as it is, not as some lagging indicators interpret it. So, if the complex strategies are out, how do we analyze market effectively? Let's talk about the power of a clean chart. Indicators can feel comforting, like they are guiding us. They often add noise that distracts us from the real story that the price is telling. It's like trying to watch a movie through the fogged up window. You might see movement but not the details. When we clear the chart, we're starting to see what really matters: pure price action. So, what do we actually need? A few core tools: support and resistance levels to identify where the price reacts, and volume to see if there is genuine interest behind these moves. These are the elements which reveal the underlying strength or weakness in the market. When we look at a clean chart, the key is to focus on structure, high and low points, and trend direction. Volume spikes help confirm the strength of these movements. Together, these signals offer us a map without the distractions. An overloaded chart pulls us in every direction, giving mixed signals. A clean chart is like a compass. It points us on high probability moves by removing the noise and helping us to see the real flow of the market. Without indicators, we are tuned in directly to price action. It simplifies our process and reduces second guess, letting us to trade with more confidence and clarity. Now that we understand the value of clean chart, let's break down one of the most powerful tools in trading: understanding market phases like accumulation and distribution. It all starts with accumulation or distribution, two phases that reveal what are the big players up to. Accumulation happens when smart money, institutions or major players start buying quietly before the big move. You'll see price consolidating in a narrow range, often after a downtrend. Here is what to look for: higher lows forming within the tight range and volume gradually increasing. This signals that the buyer is stepping in, preparing for breakout. The transition happens when the accumulation ends and the breakout begins. You'll see the price breaking out the consolidation range with a strong volume. This marks the start of a new trend. Distribution, on the other hand, is when those same big players start selling their position after a strong downtrend. Price action flattens and volume spikes as buyers get trapped, thinking the move will continue. On a daily chart, accumulation phases set up the long-term trend. On shorter time frames, these patterns give precise entry points. For example, accumulation on a 15-minute chart might align with a larger uptrend seen on a 4-hour chart. If you can spot accumulation before the breakout, you are positioned to ride the wave early, as well as recognizing distribution helps you exit before the drop. In accumulation, look for entries just before the breakout, placing your stop loss slightly below the range. During distribution, watch for failed attempts to break higher. These are often signals to exit or go short. Before I talk about the breakdown of levels and the change of the structure, let me remind you that the right tools can significantly improve your trading strategy. My team and I can develop a trading bot for you based on your strategy, which will help you not only predict the market behavior, but also automatically manage your transactions, minimizing the risks and simplifying the trading process. You can can find more in the video by following the hint or contact me using the links in the description. What is a breakdown of a level? When price breaks support or resistance level, it often signals about a shift in the market sentiment. A support level, for example, acts like a floor. If it breaks, it tells us that the sellers are in control, potentially starting a downtrend. A real breakdown starts with strong volume and the decisive candle close below the level. False breakouts, on the other hand, occur when the price dips below the level but quickly recovers. After breakout, wait for a test of a broken level. If the support level now acts as a resistance, it's a strong signal to enter a short trade. Tests show that the market accepts the new structure. A failed attempt to reclaim the broken level often leads to a strong continuation in a new direction. Here is an example. Price breaks below the support, retests it, and fails to move back above. Entering a short trade here with a stop above the new resistance level sets you up for a strong downtrend. How to identify support and resistance levels? Support is where the price tends to stop falling, and resistance is where it struggles to go higher. To find these levels, look for areas where price has reacted multiple times in the past. These zones act as magnets. If price approaches a level with strong momentum and high volume, it's likely to break. But if it quickly rejects the level, it's more likely to hold. But remember to look at higher time frames. Daily levels represent a strong market consensus because they reflect broader trends. These are the levels where major institutions often place their orders. Start with daily levels for the big picture, then zoom into 4-hour and 1-hour charts to adjust your entries. This multi-time frame approach ensures precision. Lower time frame levels, like on 5-minute chart, useful for day traders but can be easily broken. Daily levels, however, are much stronger and more reliable for swing trades. Now let's bring it all together with a real-life example of how to use these tools in the trade. Let's put theory into practice. Here is how I analyze BTC-USDT trading pair. The BTC-USDT is liquid and volatile, making it perfect for spotting clear support and resistance zones. First, I would identify daily support and resistance levels. Then I'd look for confirmation on 1-hour chart, like rejection at resistance or consolidation at support. If price approaches support with decreasing momentum, I'd look for a buy setup. For selling, I'd watch for rejection at resistance with strong bearish candles. I would exit near the next resistance level or when I see volume dropping, signaling the move might be losing steam. This analysis combines clean charting, key levels and price action to create a simple yet effective trading plan. Let's talk about momentum and candlestick ranges. Momentum shows how quickly price is moving. Strong momentum near a key level often signals a breakout, while weak momentum might mean a reversal. White candles with strong closes indicate high momentum. Narrow candles, especially near key levels, suggest indecision or exhaustion. If candles shrink and volume drops after a strong move, it's a sign that the market may reverse. This is where we can prepare to exit or go against the trend, but try not to enter against the large trend of the market. Together, these factors tell us when to enter and when to exit with confidence. High momentum confirms trends, while fading momentum warns us to be cautious. With all these tools in hand, let's wrap up with the most important takeaway. The secret in trading isn't just strategy, it's patience and discipline. Waiting for clear setups and avoiding impulsive trades is what separates successful traders from the rest. Focus on consistency and long-term growth. It's not about running marathons in one day, it's about making steady progress. Patience and discipline help traders grow faster, as the other videos on my channel. If you already have a strategy that you want to implement into a working bot or want to test it with our bots, send a message to me on Telegram by links in the description and comments. Bye!